We will keep tracking all of it. As also we are tracking Indian equities. What a day it's been for them. The Sensex has surged past 82,000. The Nifty has crossed a significant level of 24,800 today during the session. And this has happened for the first time in 31 sessions that the Nifty has closed above 24,700, which would mean that the bulls are firmly in control of the large street. Well, this rally has been powered by strong momentum in IT stocks, also some of the auto names, along with a remarkable 10-day winning streak in the broader markets. So the natural question to ask is, what's driving this exuberance? Are we set for an extended bull run? Or should investors now brace for some more turbulence, some more volatility, given both domestic and global uncertainties? To dissect the market moves and also understand what the road ahead could be like, whether it's going to be dodgy or it's going to be rocky, we're joined tonight by Sunil Subramaniam, Managing Director at Sundaram Mutual Fund. Welcome, Sunil. Thanks for making the time. Always good to have you on the show. Now, with the Nifty reclaiming levels not seen for more than a month, Sunil, do you see it as the beginning of some sustained upward trend?
Well, I think definitely it's a beginning because the FIIs, I think, have returned. And you mentioned in your run-up that the IT stocks, so they are always the FIIs' favorites. So I think the rally today, I would say, is a factor of 3-4 things. And whether it's sustainable depends on that. So first is, I think the GDP numbers being so bad actually confirmed the market bias which was there because of the earnings season being very low. Now, if the GDP had done well and the corporates were not doing well, that would have been a cause for concern. But the earnings season coming bad and the GDP numbers bearing that out was number one. They feel that the worst is now behind us because the reason why the GDP numbers came bad also became very apparent. The government spending on capex had dropped down dramatically and inflation was eating into consumers' pockets and hence consumption numbers were not looking good. Now, post that, you see the Diwali numbers for the auto have been fairly good, 32% rise in the auto. So some festival season sales obviously has taken place in the month of October. The second thing which makes the market feel that the worst behind us is the PMI numbers. Both the manufacturing and the services PMI are holding at 56, 57 levels, which is very, very strong expansion indication that will come back. The third is with the Maharashtra election also now behind us and the government having spent, I think, 46.5% of its fiscal deficit in the first half, now leaves room for the balance 54% to be spent. And mind you, the government needs to spend this money before the financial year because in the budget, if they are going to project a higher capex, they have to spend capex this year. So the market believes that the government will step up the capex level activity in the month and next month. Then the inflation number. Now the inflation number has come much above, but bear in mind that the RBI in their previous policy had projected this month's inflation to be high. It came a little higher than that, but it's not unexpected. And the monsoon being good should ultimately play out because it's food inflation which is driving the inflation up because oil prices have been fairly steady. So if the monsoon numbers play out, then you can expect a gradual easing of the inflation in the next month. Now, the point is, with such a situation in mind, RBI, right, while they cannot jump into a rate cut because the print of inflation being high, but at least the liquidity, because RBI has been using the liquidity to fight the rupee dollar on the currency part. So there has been a liquidity dry up. So the market now strongly believes that a CRR cut is likely because the market, they need to pump in liquidity in the market. And CRR is one of the tools. SLR is the other tool through which they can relax the rules and pump it. Now that then augurs well that not only is the CRR cut expected, they also expect the commentary from the Reserve Bank to be more accommodative and to say that if the inflation trajectory comes down, we can look at a rate cut in February. Now, the market, if then they see that it's not going to be one rate cut in February, probably over 2025, you might see two. So from the equity markets perspective, right, it's a sweet spot because the worst in the economy is behind us. You are expecting the current quarter's numbers driven by festival season to look better, which means earnings guidance forecasts when they come out of the January quarterly earnings result for the 2025 year could be improved. So what better time than to buy when there is pessimism around? And I think that's stepped in. And it's also probably been a trigger from overseas because in the overseas, what's happening is the US GDP numbers are looking good, but inflation is also looking like heading down. So it's a sweet spot there too because a strong US economy, if the rate cut cycle the market has been going up and down on whether the rate cut cycle will happen, not happen. But the latest inflation trajectory indicates that there could be rate cuts in place, which is very strong feedback for the US economy. And that's a strong for the risk on factor, right? So the
Right.
risk on, then emerging markets also get their flows. So today we're in a sweet spot and all these things seem to have come together.
Right.
Now, whether this will sustain, no, I think that, look, for another week.
But Sunil, as far as the RBI is concerned, as far as their commentary, it's going to be an important one to look out for, whether or not, like you said, they're going to be more accommodative or not. But even apart from that decision, there will be certain key domestic triggers that could fuel this rally or maybe even derail it. What do you imagine those would be?
So I think that, so first of all, like I said, the market now expects that the economic recovery to come. The government should step up on the capex. Now, if the government doesn't, and the next quarter's numbers also show a GDP continuing to be at a 5.5% level, markets will be disappointed. So that's one which the earnings season will give a good guidance. So till January 10th, when the earnings season comes, there are no real big triggers on that. A negative trigger to watch out is like an oil price hike because of the geopolitical tension. Not expected at the moment, but you're asking for what can spook the market, and sudden spike in oil prices if OPEC suddenly gangs up and decides that they will cut production and oil prices start rising. That's a negative for India, number one. Number two is in the US, if the rate cut scenario doesn't look positive.
Sunil, I don't know if you've already consumed the news that OPEC Plus is likely to push back production until April. And if that happens, then how do the markets react?
Well, that's what. But the US is a counterfactor. Trump is going to pump oil like there's no tomorrow. So I think you got to bear in mind that for Trump, US inflation is important. So, and he's already said that he will support shale gas reopening and pumping oil. So I think oil production as well as US things augurs well for that. And so unlikely to spike or spook the markets.
About PSU banks, which have significantly outperformed this year, Sunil. The PSU bank index has surged 25%. And this even as the bank nifty has managed only a 10% rise. So in comparison, it's done well. Will this momentum, you think, sustain when you talk about PSU banks?
I think it will for two reasons. One is a CRR cut is likely to benefit PSU banks a lot. Any liquidity push, because they are the ones who are overweight on government securities. So if the CRR cut is accompanied with a SLR also coming down, PSU banks will hugely benefit. Second is, I think PSU banks are the financiers for the capex cycle. So when the government steps up, right, the capital goods suppliers and all will go to the PSU banks for lending. So I expect the corporate lending. When corporate lending picks up, PSU banks are always at an advantage compared to your private sector banks. So I think, yes, PSU banks, I would say, are a good bet. Good quality banks are a good bet with a year's perspective in mind.
What about IT and auto stocks, Sunil? Because they've led today's charge in the markets. Do you see these sectors continuing to outperform, or should investors look at other undervalued sectors?
No, I think IT should continue to be a good pick. The reason being that as the US money starts flowing back into India from January, their comfort zone will be in IT, because if the US economy is recovering strongly, it augurs well for IT spending by them. Second, a US rate cut, which is positive for the BFSI sector in the US. Again, they are one of the biggest buyers of IT. Third is a dollar strengthening with a rupee weakening is again favors IT. So I would continue to keep IT as a top pick in this period because of all these reasons. As far as auto is concerned, see, I think that the October sales were very good on the back of Diwali, but the November has been disappointing, especially in the two-wheelers and the bottom of the pyramid. So I think that the current rally that you're seeing there is not driven by these numbers, but an expectation of the consumer discretionary pack. So I would say that for me, auto sales and auto numbers and all will probably take another month or two to recover at the ground level. The market action on auto today is honestly a bit of surprise for me from that outlook perspective, but that's probably because people are betting a little more into the future than the immediate near outlook.
About the impact of the Indian rupee and how it does against the US dollar, it has shown some amount of resilience lately, but it's going to be critical, the INR's movement in sustaining foreign inflows and boosting market sentiment as well. Would you agree?
No, actually, I have a contrarian view there. First of all, the rupee hasn't weakened as much as the Chinese yuan or any other currency. The rupee actually on a REER, that is real effective exchange rate, when you look at the basket, has actually strengthened. This is the dollar strength which is reflecting in the rupee's weakening and not any fundamental rupee weakness or current Indian currency's weakness. That's number one. Number two is that because of the weakening which has already occurred from a foreign investor's perspective, he's already coming into a weakened currency. So for him, from now on, his benchmark is will reach in further, which I don't see strong reasons for. So I don't think that any further weakening, right? Because the Indian economy is on a strong wicket developmentally, and the interest rate differential between the US and India, that's the key factor to track. So I'm not of the view that any expected currency weakening is hindering FII flows. FII flows have been hindered for other reasons like a negative emerging market sentiment favoring the US. A strong dollar means that strong higher interest rates in the US means they get a better return on a risk-free basis from the US. And this is an overall emerging market story and not for India specific. India, it was more related to the earnings season not being so great. And that, I think now with the GDP numbers confirming, will mean that FIS could start flow back. But bear in mind that the last 2 weeks of December are holiday season. So very, very thin trading. I would expect January to be the next strong uptick in the markets.
And very quickly, Sunil, about the broader markets, which have shown some exceptional strength over the past 10 sessions. What do you suggest retail investors do at this stage? Chase the rally or exercise caution right now?
See, the answer to that is very simple. The mutual funds have been largely buying on the back of the SIP book, right, which has been going steadily month on month. Now, if you analyze the 25,000 crore SIP book, almost 13 to 15,000 crores is in small and mid cap schemes. So mutual fund managers, I have no choice but to buy good quality small and mid caps. So the liquidity with the fund managers is driving. Because SEBI has put very strict restrictions saying a small cap fund cannot buy more than 35% non-small caps. A mid-cap fund can't buy more than 35% non-mid caps. So if you get money into those schemes, you have no choice but to buy good quality schemes there. So from a retail investor perspective, rather than chase stocks, because you have a large pool there. You have 250 stocks for the small cap from 250 and 150 stocks for mid cap. You invest in mid and small cap funds because those fund managers are already having money there and they are going to drive up these stocks. Picking the right stock, the right sector, leave it to the hands of the fund manager. So from a retail investor's perspective, I would say it's a good time to allocate to mid-cap and small-cap schemes of mutual funds, whereby they can really get the benefit of the rally that's coming.
This issue as well in a moment. SEBI has proposed an internationally followed practice of close auction session, the CAS system, to determine the closing price of a stock instead of the current practice where they use a volume-weighted average price. How do you think that's going to go, Sunil?
No, I think it's something that FIS would like because when you are more aligned with the international practices, otherwise it's a guesswork for them on the volume versus weight kind of a calculation. So the more we get aligned, it's better for a price discovery. And I would think that FIS would welcome this move from their perspective. And they are the ones who are moving the market. So overall, this is a positive for the market.
We'll get you more details, but of course, as far as markets go, they continue to chart this rather intriguing course, the bulls and bears fighting it out. Focus on how key sectors are going to perform, the interplay of global and domestic triggers, crude oil prices for one, the Fed policy and how the RBI is going to take its cues from rising inflation and lower growth concerns, and how investors are going to position themselves in times to come and how we're going to see those SIPs rise or not. Lots to factor in when you decide your equity market strategies, but always good to get perspective and advice from market experts like Sunil Subramaniam. Thanks very much, Sunil, for joining us this evening on India Tonight.
Thank you.
Meanwhile,